Welcome to Reimagining the Community Reinvestment Act, Combating the New Frontiers of Redlining by the Economic Equity team at the Greenlining Institute. For those of you who do not know, the Greenlining Institute is an incubator of new policy ideas, a bridge builder between community and government, and an advocate to build momentum for transformative change. Our vision: the Greenlining Institute works towards a future where communities of color can build wealth, live in healthy places filled with economic opportunity, and are ready to meet the challenges posed by climate change. Some of our economic equity work includes the racial wealth gap, federal bank reform and regulation, fintech and non-bank regulation, bank accountability, diversity, housing affordability, women of color wealth gap, and climate finance. To understand the concept of the Community Reinvestment Act and why we have it, we need to understand redlining and its effects on communities of color. So redlining was a longstanding practice, or is a longstanding practice, in which the federal government and banks restricted lending in certain neighborhoods because they deemed them too risky based on primarily the race and the ethnicity of residents. Financial institutions drew red lines around communities, deeming these areas hazardous for investments, which led to the systematic denial of wealth building opportunities for low-income communities of color. Redlining's legacy lives on through unregulated algorithmic bias, which uses zip codes, proximity to pollution, health indicators, and educational outcomes to make lending and investment decisions. The effects of this are continued denial of home mortgage loans and higher interest rates and fees, predatory lending, higher home insurance rates, and lower home appraisals for communities of color. So here is the Oakland redlining map. I'm not sure why oh, there we go. They're popping up. This Oakland redlining map from 1937 stays fairly consistent throughout the years. If you see the Callan-Biro screen map, which shows health outcomes due to pollution, and the Oakland COVID-19 map. It's therefore no surprise that we can draw a direct parallel between neighborhoods that were excluded from investments through redlining, neighborhoods that suffer first and worst from pollution, and today, neighborhoods suffering most from COVID-19. And the common denominator between all of these is race. So the Community Reinvestment Act, what is it? It was originally passed in 1977 as one of the last civil rights era bills to address fairness and financial inclusion and access to housing and credit. So long story short, it made the practice of redlining among financial institutions and governmental organizations illegal. The CRA establishes an affirmative and continual obligation to serve the credit needs of low and moderate income communities. However, even though the bill was meant to address redlining, which mostly affected communities of color, there's no language around direct investment in communities of color. There's no explicit language around race. So based on their size, banks are required to undergo a CRA exam by the federal regulatory agencies to examine a bank's record of meeting the needs of their entire community through credit. And the CRA has shown to be effective. Since 1996, banks covered by the CRA have invested more than $980 billion in historically underserved zip codes, and that number is consistently increasing. Why does the CRA matter? Because of the CRA, banks are obligated to interact with our organizations and come to the table with us to fulfill CRA eligible activity. So banks negotiate community benefits agreements, CBAs, with our organizations, which is a bank's pledge to reinvest billions yearly into our communities. And through those CBAs, they spell out specific investments and benchmarks that they want to hit, which counts for CRA credit within the CRA exam. We can hold them accountable to public benchmarks, and the CRA creates a record of a bank's reinvestment in our communities. Bottom line, the CRA has resulted in trillions of dollars in lending and reinvestment in our neighborhoods that need it the most and have historically been redlined. So the CRA exam. This is the process used to determine a financial institution's compliance with the CRA. The results of the CRA exam are considered when a financial institution applies to open a branch or merge with another institution or become a financial holding company. The effectiveness on the CRA, however, currently the distribution of ratings is about 98% passing and 90% satisfactory. So even though we know financial institutions may still be redlining communities of color, and the racial wealth gap continues, they're still kind of passing the CRA exam with flying colors. And just for some definitions, an assessment area is a geographic area within which the examiners will evaluate a bank's performance. And up until the Notice of Proposed Rulemaking, which I will go over in a couple slides, the assessment area was limited to a physical geographic branch or location of the bank, which is a little bit outdated. And performance tests, so there's 4 categories: retail lending, retail service, community development financing, and community development services. So who are the regulators? Who are the regulators involved in changing or updating the Community Reinvestment Act? So there's the OCC, which regulates all bank holding companies, financial holding companies, and state chartered member banks. The Federal Reserve Bank, which regulates banks with a national charter, and the Federal Deposit Insurance Corporation, otherwise known as the FDIC, which regulates non-Federal Reserve member state chartered banks. So each of these federal regulators are responsible for regulating a different type of bank. And last time the CRA was substantially updated by all these 3 agencies was 1995. Since then, the financial system has changed with expanded online banking and interstate lending, while racial disparities in lending and wealth creation have persisted or worsened. So eligible CRA activities, just for a little snapshot of what investments and activities banks actually receive CRA credit. They're identified as targeted loans, investments, and services provided by a financial institution among low and moderate income communities, CRA eligible communities, Native individuals, families, and businesses. And they also get CRA credit for qualified community development activities. These can also be seen more through broadband infrastructure, climate resiliency, affordable housing, and community services. Just for an example of what can receive CRA credit in the most recent US Bank and Union Bank Community Benefits Agreement were 3 special purpose credit programs in small business, mortgages, and affordable housing development that are targeted towards low and moderate income communities. Some CRA shortcomings. So the regulators must update the rules to reflect new technological developments. So as banks close branches, communities of color become vulnerable to predatory lending among non-banks, which operate exclusively online, and major financial institutions who are also starting to operate largely online platforms. The CRA must more explicitly address racial inequities. Banks have this continual obligation to low and moderate income communities but not to communities of color. And lastly, they should provide guidance for more climate investments. The legacy of redlining has resulted in neighborhoods lacking adequate investment by banks, while also commonly bearing disproportionate environmental burdens, which result in increased vulnerability to climate change and its effects. And just a couple more facts and figures. Black and Hispanic households are around 5 times more likely to be unbanked as white households. The current wealth and homeownership gap between Black and white Americans is roughly the same as it was before the passage of the Civil Rights Act of 1964. Black-owned businesses are more likely to be denied credit, even after controlling for differences in creditworthiness. And bottom line, communities of color need stronger protections to combat the new frontiers of redlining. So what's in the NPR, which is the update and the changes to the Community Reinvestment Act that the 3 federal agencies just announced in May? What's in it? So CRA eligible activities. Expanding the scope of the activities that qualify for CRA credit, such as loans and investments on reservations and minority depository institutions, and clarifying the activities that qualify for CRA credit, so they're more targeted. In assessment areas, so adapting to changes in the banking industry, including internet and mobile banking. This is huge. Large banks would have the responsibility to lend to people with lower incomes, not only in the areas around their physical branches, but also in places where they have a concentration of mortgage and small business loans. And tailoring CRA evaluations and data collection to all bank sizes and type. So one of this is updating the CRA evaluation framework, which tailors performance standards to small banks, intermediate banks, and large banks, where there will be a harder test for large banks. And lastly, including Home Mortgage Disclosure Act racial data on the exam, which calls for large banks to disclose the racial and ethnic background of borrowers. Even though it will be included in the CRA exam, it won't impact the score. And this is just a snapshot of the new NPR framework. So it shows the small banks, intermediate banks, and large banks, and the tests that they will have to go through. Obviously, you can see the large banks will be assessed under more categories. And I'll pass this on to Rowan.
Thanks, Rami. So like Rami described, that those were the proposed changes to the CRA by the 3 federal agencies. Something that's glaringly missing from those proposed changes is any explicit consideration of race. So again, like Rami said, although CRA was a direct response to redlining and to housing discrimination, the law does not take race into account. And despite the federal regulators, in their talking points and talking about the proposed rule and this historic opportunity, they've, all mentioned their commitment to racial equity and wanting to, increase the consideration of race in the Community Reinvestment Act. We didn't see race in the proposed rules. And so one of Greenlining's priorities in our response to the proposed rules is to ask the regulators to more explicitly use race data in these performance evaluations. So that's through several areas. One is to assess bank performance through the percentage of home lending to BIPOC borrowers. So the proposed rules already say that they'll include in CRA exams race data taken from the Home Mortgage Disclosure Act, which is a requirement of banks to collect race data on mortgage originations and purchases, but we are suggesting that they actually use that data as part of the assessment. We're also proposing that the regulators use race to determine additional assessment areas. So right now, they're planning to determine assessment areas based on income and where lending is taking place, but it should also be based on minority majority neighborhoods. We would also like to see and think that there should be more analysis by race and ethnicity in underserved neighborhoods in all CRA exams. So this is including community development financing and retail lending, which is missing from the proposed rules. We'd also like to see greater consideration of the special purpose credit programs that Rami mentioned earlier that we've seen begin to be included in community benefits agreements and that are recommended by the CFPB, but we haven't seen banks utilized to the full extent. And so we would like to see special purpose credit programs explicitly outlined and encouraged by the regulators in CRA. And something that's not on the slide is we'd like to see more use of Section 1071 data. So Section 1071 of the Dodd-Frank Act now collects race data for small business lending. The rule currently says that that data will be published and included in CRA exams, but it won't be used as part of the analysis. And we think it should be used as part of a fair lending analysis of financial institutions. And now I will pass it to Monica to discuss some climate considerations.
Great. Thank you, Rowan. Hi, everybody. Monica Palmera. I work on climate finance issues here at Greenlining. So wanted to just take a quick minute to talk about some of the climate resilience pieces in the proposed rule. So historically, regarding the Community Reinvestment Act, banks have received credit on their CRA exams for making some investments in quote unquote disaster recovery efforts. But what we understand from financial institutions and from stakeholders is that it's been largely unclear what counts in that category of disaster recovery. And so it was really important for the regulators to propose a lot more clarity and to propose something a lot more proactive than simply disaster recovery, while acknowledging that disaster recovery is certainly important. So the proposed rule does include a new definition of disaster preparedness and climate resiliency. And it's a strong definition that acknowledges that climate change is coming and that we need to help communities prepare for those impacts. And it includes a discrete list of eligible investments where banks could get credit for providing, which would provide meaningful support to communities. Some of these investments could include things like heating and cooling centers, energy efficiency infrastructure, things of that nature. So overall, we're, in terms of, the CRA historically being, silent on climate issues, we are very excited to see the regulators propose this in the rule, and we're certainly supportive of including climate resiliency. We will be including recommendations of more investments, more examples of investments that banks could, invest in that would help communities in climate preparedness and climate resiliency. And so that's one big thing that we'll be focusing on. Another thing that a couple of other things that we're going to look at on the climate side in the proposed rule is how to incorporate climate vulnerable communities into assessment areas. So like Rami and Rowan mentioned, the banks are evaluated on these assessment areas, which have historically been just where the banks have branches. Certainly we want to prioritize race as an element of that, but we want to think about how we can incorporate climate vulnerable communities there using various tools that we have at our disposal to be able to channel investment to communities that really need it. So we'll be looking at recommendations there. And then the last thing, I didn't end up putting it on this slide, but we also want to acknowledge that a lot of these banks are making investments in facilities and in activities that harm our communities. You can think about refineries or certain kinds of plants, things that create environmental burden in our communities. And so we are looking at the CRA and CRA Exam as a potential place to ding the banks, to deduct points where they are causing harm. Because while it's good to invest in climate resiliency, we can't just, we have to look at both sides of the coin, right? If there's harm being committed on behalf of the bank, we want to see if there are opportunities to penalize them for it in this process. So those are the things that we're going to be looking at from a climate perspective. And just want to quickly plug, I think Rami has it on a follow-up slide. There will be another webinar focused on climate that we're doing with some partner organizations next week. So if folks are really interested in digging into the climate components, stay tuned for that. There'll be another opportunity to go more in the weeds there. I'll pass it back to Rami.
Thank you so much, Monica. Yeah, we will link that webinar down in the chat. And I bet some of you are wondering, what can we do about this? How do we take action? So the deadline to comment on the federal rulemaking is August 5th. Historically, federal agencies receive a plethora of comments coming from banks opposing their own regulation. So it's our job to ensure that comments are coming from communities who are unbanked, underbanked, and affected by redlining. So we created a toolkit, which includes signing on to the Greenlining Institute's comment letter and the opportunity to submit your own comment letter using our sample letter. The toolkit includes how to submit to all three agencies. I know that's like kind of ridiculous that there's no combined process, but when you do type up your own letter using our sample, if you'd like, there are instructions to submit to all three agencies. And I will be available to help with any of the back-end work. So I'll follow up as well and give my contact information, as long as a recording of the webinar for your use. And we'll also link the climate justice webinar in the chat. And the Greenlining Institute's comment letter is still in the works. So we will also be following up with a confirmation once the letter is finalized. So it's only a tentative sign-on. And that is it for the webinar. Thank you so much for joining us, but also we would love to take any of your questions. We want this to be kind of a Q&A forum. So please unmute or type your questions in the chat, and we will do our best to answer any questions that you have. Any questions? No questions? Awesome. And the toolkit is also linked, and I'll be following up with that as well. And we have a question from Luis. Could you speak a little bit more about special purpose credit programs? Rowan, are you down to jump in?
Yeah, thank you for the question. So special purpose credit programs are allowable from the CFPB. They allow financial institutions to make focused lending programs to specific populations. So like low-income communities or veterans, women. These are like not used very often, but they allow banks to kind of have like targeted products. So like one of the products that US Bank just implemented is like a specific small business product to low-income communities. This is a product that has maybe different rates, fees than a traditional small business product. It's targeted towards communities that wouldn't qualify for their traditional product. So special purpose credit programs can be an effective tool at for increasing lending and access to capital to underserved communities. So it's something that, although is allowed, there is some guidance from the CFPB around it. It's underutilized because financial institutions fear that they'll be called out for discrimination or that it won't be allowable under a COA. So what we're asking for is for the federal regulators in this NPR to make it more clear how to use special purpose credit programs and how to implement them, and to incentivize special purpose credit programs by giving banks credit on their CRA exams for implementing them and using them. So that's just an overview of special purpose credit programs.
Thanks so much, Rowan. And Carla, thank you so much for your question. I think you joined late, so we went over some of the changes being updating assessment areas to include mobile banking, a more difficult test for large banks, and an updated CRA qualifying activities. I'm going to send the PowerPoint presentation along with the webinar out after this webinar. So you'll be able to read some of what's included in the Notice of Proposed Rulemaking. And Justin's question, are there any environmental justice or CBO communities and organizations engaged in this process? If not, are there efforts to get EJ and CBO representation involved? I'm going to send this question over to Monica. Awesome.
That sounds good. Yeah, thank you, Rami, and thank you for the question, Justin. You're right to point out environmental justice groups in particular. So because this climate resiliency piece is new for the CRA, we have not seen, and I'll speak for myself, we haven't seen environmental justice groups as active on Community Reinvestment Act work or investments. Not to say that there hasn't been some interaction, and if banks are making investments in community projects that might have an environmental benefit, that we've probably seen that interaction before, perhaps without knowing it. But historically, folks that have been really active in Community Reinvestment Act advocacy have been housing organizations, because there's such an emphasis on mortgages and lending, as well as small business and more, but I would say those have been the emphasis. So community-based organizations in those spaces have certainly been active here since CRA's inception, and were the ones that fought for CRA to be put into place. But EJ groups, it's new. So that's why we are trying to do this. And Rowan, thank you so much for putting it in the chat. A follow-up webinar just on climate, and trying to get environmental justice groups specifically to get engaged now, so that we can demonstrate to the regulators that this is important and this is something that's needed. There's a lot of pushback in Washington around financial regulators taking on issues of climate. There's a ton of pushback happening now. So the regulators really need to hear not just more ideas, but also just a lot of support. So it's really important that we get our EJ groups, our CBOs, and all kinds of folks active on the climate pieces. So hopefully we'll get more EJ groups involved. That's certainly a goal.
All right, well, that seems to be it for the questions. Thank you so much for your questions and engagement, everyone. I will be following up with all the resources, and I appreciate you all for joining and wanting to be involved in this. All right. Bye, everyone.